All right, my friends, so this is going to be a preliminary to the video I'm going to do on the Vanguard Managed Payout Fund. Spent all morning just doing some research on it and looking at it in terms of returns, dividend payout, and then just comparing it to the old-fashioned S&P 500. This will lead me to do another video like I've done probably 2 times, and since I've had my YouTube channel on the American Funds has this thing called the ICA Guide, the Investment Company of America Guide, and it's, man, probably one of the most fundamental pieces of sales material, sales material, investment analysis that I've ever seen in my life. It's so easy to use and to read, and just it hits you like a ton of bricks. And the Managed Payout Fund for Vanguard reminded me so much of the ICA Guide. And I've been looking at the ICA Guide probably since 2003. Every year they do it, where they have this updated version, because the Investment Company of America has been around since 1934. And it shows you the value of a growing dividend income stream. And here's the problem when it comes to Vanguard Managed Payout Fund. All right, so it does actually have a longer track record than I anticipated. Some guy had emailed me yesterday or 2 days ago. I said, man, there's not enough long enough track record for me to really give any thoughts on this. But then I revisited it. It came out in 2018. Probably could not have, I guess you could have timed it just a little bit worse if it came on October 2018. But it came out April 2018 at $20 a pop, all right, which most funds do, either $10 usually for a bond fund, $20 for a stock-oriented fund, and that's not all the time, but just generally speaking, that's usually the initial NAV, net asset value. All right, so in 2018, it dropped 40% from high to low. The Managed Payout Fund did. All right, so look at that beautiful blue jay. Blue jays are rat finks, though. They are mean, brutal birds, from my understanding, but man, they are gorgeous. All right, so the Vanguard Managed Payout Fund came out 2018 and proceeded to drop 40% in value. Oh, I wish people would pick up their poop, man. Good night. All right, so the S&P 500, of course, during the same time dropped 40% in value as well. In fact, the S&P 500, when all is said and done, was down 55% from October 2007 to March 9th of 2009. Now, what would have the Managed Payout Fund? I don't know, because it wasn't around from October 2007. But the fact it fell 40% from April 2018 to March of 2009, that right there should tell you in of itself, it is not the equivalent of a bond fund. And they don't argue that they are. They're not arguing that they are the equivalent of a bond fund. They're not. So I don't want to say like, oh, Vanguard's misleading or anything like that. But they are trying to invest in securities which will give you a decent payout relative to the net asset value. But here's the problem. All right, so back then, the S&P 500 and the Vanguard Managed Payout were paying roughly the same in terms of income. I mean, the Managed Payout was paying more in terms of income. And if you look at the last since inception, the Managed Payout Fund has paid out twice what the dividends have on the S&P 500. Does that make sense? So the Managed Payout, if you had 5 shares, and there's a reason, and I'll do it on the blackboard later or the whiteboard later on, but there's a reason I'm using 5 shares to make it comparable to the S&P 500. So essentially, back then the S&P 500 was trading at $120 a share. All right, so I'm taking 1 share of the S&P 500, and I'm equating that with 6 shares, of the Managed Payout Fund, because the Managed Payout Fund is started at $20 a pop. So I want to have even Steven in terms of how much you invested. So in this case, you have $120 to invest. One is 1 share of the S&P 500, or the other is 6 shares of the Managed Payout Fund. Hope this makes sense. All right, so in this case, we're investing $120 in each. Over the course of until the end of 2019, you would have received $77 of income on the Managed Payout Fund. All right, you would have received roughly half that, about I think it's $38 on the S&P 500. So you would have received twice the income on the Managed Fund as you would have on the S&P 500. Yay for the Managed Fund, but the Managed Fund is trading at about, for every share at $20 a pop, is trading about $16.50 or something like that, So it has actually lost about 1.45% annually in terms of price per share, if that makes sense. So if you would have not reinvested your income and just took the cash, you now have $16 for every $20 that you invested since the inception time. So if you take your $16 and you add your $77 to what you invested in the managed fund, you get a total return. And again, off the top of my head, I can't remember what that is. It'll be easier for me to show you what it means on the whiteboard. The S&P 500 and now here's the thing. In 2019, the managed fund paid all of about $1 in total income. I think it's $1.09. Again, more to come when I get to my whiteboard. All right, so even though the S&P 500 only had half the income as a managed fund going back from inception until today, in 2019, the managed fund only had $1 in total income on roughly $16 a share price. You know what the S&P 500 had in total income in 2019? About $5. Right? So even though the managed account has doubled that of the S&P 500 in terms of total income since 2008, the S&P 500 is now paying 5 times that of the managed fund. Now, grant you, in 2018, the managed fund had a $2.38 payout. I don't know what that was from, frankly. It was weird because that certainly wasn't attributed to share price appreciation or anything like that. And that was the exception, not the rule. But in 2018, the managed fund did have a $2.38 payout. The S&P 500, though, it paid out even twice, roughly, not twice, but a little bit, probably $2 more per share than the managed account did. So what's happening here, and this is, again, going back to the ICA guide, the value of a growing dividend payout with a share price that is either going up or going down, but the S&P 500 has gone up from $120 back in 2008 when it got hammered, just like the managed fund, but now is up, I think it's like twice, 250% in share price. So it's doubled, more than double the share price, and its income is now 5 times that of the managed account, the managed payout. I just don't see the managed payout falling into your realm of an investment. I don't, because you had the downside as similar to the S&P 500 in 2008. You got hammered in that fund, but you don't have nearly the same upside at all. The managed payout fund is literally paying $1 for every 5 that the S&P 500 is. And on top of that, the managed payout fund is actually worth less in value now. Significantly worse, by the way, 15% less than the S&P 500, even though the managed payout fund is even though the managed payout fund is only paying a fraction of what the S&P 500 is. So not is the S&P 500 more valuable, significantly more value in terms of just price per share, it has significant more income as well. With the same risk. Anyway, I hope that helps. This just goes back. You have to have growing dividends. I mean, if you're going to get income and you're stagnated, we're not even talking inflation either. I mean, if you factor in inflation, the managed payout is not even hardly keeping up with inflation. And then you factor in taxes there, it's not. And then you factor in price depreciation, it has lost money. You've lost money. In terms of price appreciation, because it's down. It's down from $20 a share at inception to about $16 a share now. That's a 15% price depreciation, whereas the S&P 500 has gone up by, like I said, 250% since 2008. And again, this is inclusive of the 2008 year going into 2009. This isn't, just casting out the bad and only looking at the good. This is the exact opposite. So then you could say, well, what if we got rid of the 2008 debacle? Well, then the S&P 500 is even going to look better. Because again, growing dividends, price appreciation, no downside at all to speak of. And on top of that, the managed payout fund even though it didn't have any significant downside, essentially what's going on is a managed payout fund couldn't hold its own to the S&P 500. There's just no getting around that. There's no getting around that. So I'm telling you, man, I would stay away from it. I would stay away from any of these funds that pay out a certain amount of money. Now, on top of that, the current yield of the managed payout fund right now is over like 6.5. That sounds good. Where does that yield come from? I'm telling you, man, where's that yield coming from? There is no way they're going to pay that kind of yield out without getting seriously hammered on price per share, or because they're taking way too much risk, or they're paying out of par of principal. And there's just no way, because nothing out there is paying 6.5 that's not inherently risky. So they're not going to. So what I'm saying is, remember, the yield is the previous payouts. All right. So last year they paid $1 on whatever the share price is today, $16, something like that. That gives them a 6.5% yield. You are not going to get that this year. 2020, you are not going to get a similar kind of payout you did in 2019, because there's no way they can make that happen without paying you part of your principal. If they pay you part of your principal, that literally means your principal is being declined right in front of your very eyes. Don't do that. That's kind of like an annuity in that regard. But at least with annuity, there's no downside risk. You know for a fact what you're going to get. So this, to me, it seems like a depleting asset that's happening right in front of your very eyes. So you're going to have a couple things happen. You're going to have all your money gone because they're paying out principal in order to keep up the viewpoint of a decent payout, or the payout's going to drop like a brick in water. And that's what's going to happen. The payout is going to drop like a brick in water. So the S&P 500 keeps going up, from $5 to $6 to $7 per share, this guy's not going to do that. This guy's going to go down from $2.38 to $1.15 to 99 cents and whatnot, just because they can't have the money depreciating all the way down to zero. So hope this helps. Again, I'll put it on the whiteboard to more visualize it, but man, I just think you should stay away and just do the barbell approach and be done with it. Or just put it on the S&P 500 and live off the dividends. I got no qualm with that either. I mean, if you did that, you are sitting on $5 of dividends today, when before you had a whole lot less than that. You have a growing dividend stream and you have 2.5 times your money. All right, we'll see you.